Hello everyone, here is Ali Talabi and this is the third lesson from the sixth module. So we are going to wrap up our lessons related to bonds and bond valuation. So we'll talk about different features of the bond. More specifically, I will talk about semi-annual bond, and then we'll talk different type of corporate bonds, and I will introduce some new terms. And finally, we'll wrap up with the notion of default risk. So let's talk about semi-annual bonds first. So we talk about bond prices, and so far we assume the payments are happening once a year when it comes to coupon payment. But most of the bonds in the US, in the North America, most of the bonds are paid on semi-annual basis. What does it mean? Semi-annual, it means you receive two equal payments over the year. So to explain this concept, I'm going just to show you an example and what kind of changes you need to make here. So let's assume the current coupon rate for a bond is 6.5%, and we're talking about the semi-annual bond. And the face value is $1,000, and the maturity date actually is 3 years from now. And required return, or that expected return, or that YTM we talk about, is 6%. So what is the current price of this bond? So as I mentioned before, you need to make some adjustment, and you see these adjustments here. First, you need to double the number of periods. What does it mean? Actually, the N is usually given in terms of year. For example, here you're talking about 3 years. However, this is the semi-annual payment. So if you go with the semi-annual payment, your number of payments is going up. So here is your timeline. So you're talking about 3 years. However, this is the semi-annual bond. So which means every year you receive twice. After 6 months, after 1 year, after 18 months, after 2 years, after 2 years and a half, and after 3 years. So what does it mean? It means your total number of payments is not 3 anymore. Your total number of payments is actually 6. So you need to double your N. So I'm going to double my N. I'm going to use 6 here instead of 3. The second adjustment is you need to have the coupon payment, or the annual coupon payments. In this example, I'm saying that the coupon rate is 6.5%, which is $65 per year. But we are going with the semi-annual, which means your payment should be $32.5. So I'm dividing by 2 the annual coupon payment. And you need to have the discount rate, or the YTM. What is your annual discount rate? 6%. So instead of 6%, I need to use 3%. So based on that, I can find the present value of the bond. And for sure, you don't need to change the face value of the bond, which is same as $1,000. That's the total value will receive at expiry date. So if you make these changes, now you can calculate the present value of the bond. Again, I'm using my financial calculator BA2 Plus. If you have some challenges regarding using your calculator, please go back to the time value of money module. I explain how to use your calculator to find the present value of cash flow. So 6N, 3I, 32.5 PMT, 1000 future value. You are computing the present value, and that's the number I have. So as we talked in the second lesson of this module, I mentioned the present value should be negative because that's how much you're actually paying for the bond. So $1,013.50. So this is the present value, or the value of the bond you need to pay now. So for sure you can change the frequency of payment. So you can go with the quarterly payment, monthly payment. The argument will be same. Just you need to make adjustment to these 3 variables. Adjustment to number of periods, adjustment to coupon payment, and adjustment to interest rate, or YTM. Now let's talk about some features of different corporate bonds. So we talk about the something which is called a straight bonds. But the bonds might be zero coupon bond. What is the zero coupon bonds? Some of the bonds, they don't have any coupon payment, and you just receive a lump sum at the end of expiry date. If that's the case, we call that zero coupon bonds. So how you find the value? It's much easier because there's just one payment. So you will find the present value of that lump sum. So you will receive a specific amount 5 years from now. Just find the present value of that amount and discount it back for 5 years. Floating rate bonds. Some of the bonds, they don't have the fixed coupon rate. The coupon rate actually varies or changes with the inflation, with the market interest rate. So we call them floating rate bonds. So if you want just to hedge yourself or be safe against inflation fluctuation, you can consider buying those bonds. And for sure, the present value of those bonds, it's a bit more complicated to calculate because you need to go with different coupon payments depending on the coupon rate. We also have the convertible bonds. Some of the bonds, they have this feature that you can convert them to a stock. So for example, and you know in advance how you can convert your bonds into a stock. For example, there is a 1-to-2 or 1-to-3, which means for each stock you need to actually give back or give up 2 of the bonds or 3 of the bonds. So you will be a stock owner of the company. So that's another feature which is actually given to the bond holders. Another feature which is very important, it's called callable bonds. Some of the bonds are callable. I'm going to talk about this a bit more. So these bonds actually, they have the embedded call option. What does it mean? It means the issuer, the company, the government, whoever is selling this bond has this ability or the option to actually buy back its own bonds. So they can buy back and pay you a specific lump sum. Now, this specific lump sum, which is also called price, most probably is greater than the face value. So that's a kind of incentive for you to buy such bonds because it's not a good feature for the bondholder, for the investor. You don't want, if you're earning a good interest, if the market is paying much lower interest and you receive a high coupon rate, you want to keep or hold on to your bond. But the issuer doesn't like it because they want just to cut their rate. So what they do instead, they call their bond, they buy back their bonds, and actually they pay you the call price, which is a little bit greater than the face value. I will talk about this later, and I will show you how to find the YTC or yield to call or the return of these bonds. We have another bond which is puttable. So the callable bonds gives the issuer the option to buy back its bond. The puttable or retractable bonds gives the bondholder to actually use the option of selling back to the issuer. So if you have the right to sell back the bonds to the issuer, it's a retractable bonds, which you love it, you like it because you know that's opportunity for you. If the market's paying higher coupon rate, the interest rate is higher, you want just to get rid of your bond and then buy the new bonds with a higher coupon rate. So I promise I'm going to talk more about the callable bonds. So we already mentioned what does it mean to have a callable bond. The major part here is just to focus on valuation of the return. So if you have the callable bond, you should expect to receive a return which is different than what we call YTM, yield to maturity. The return on callable bond, it's not appropriate to use YTM. So you don't want to use the YTM to find the return callable bond. Why? Because the expiry is not same as the expiry on regular or straight bond. You might be called to sell back your bonds to issuer at the call price much earlier than expiry date. So the question here is, what is your annual average return on such bond? So as I mentioned, we use the term YTC or yield to call. So your yield to call is a bit different than the YTM. And what is the major difference here? This time, if you want to find the bond price, you shouldn't use the YTM. You should use something which is called YTC. And there are actually three major differences. First of all, we talk about that you don't use the discount rate or interest rate as YTM, you use the YTC. That's the first major difference. The second major difference here is the T. The T is not same as what we had before for the YTM. Actually, the T here is showing how many years you have until calling date. Again, how many years you have until calling date. Because actually, when it comes to callable bonds, they give you some specific years. So let's say we're talking about 5 years until expiry date, and you are here, present time. However, the bonds are callable 2 years from now. So it means after 2 years, the company is able to buy back its own bonds from you. So in this case, your T should be 2, not 3, not 5. So T is showing the number of years until calling date. That's the second important difference. And the third one, so it was the second one, and the third difference is the call price. If you remember, for the YTM, we used the face value, which was $1,000. However, the money you will receive at maturity date or calling date is not same as what you receive in the regular straight bond. So usually you will receive more than face value, which we call call price. So for example, if the call price is $1,000 100, use that $1,000 100 as your CP. When you are entering the numbers, your calculator, you use that as the future value. Still, you're using that as a future value, but it is not same as $1,000, which was in YTM. So you can use these features, and for sure you can calculate the YTC using your calculator. The calculation is same. Just make sure you are using the updated numbers based on what we argued here. And then based on that, you can calculate YTC, which in your calculator will be I per Y. Now, we notice that the discount rate or the YTM and also the coupon rate for different bonds are different. So you don't receive the same yield and the same coupon payment for different bonds. Why is that? We know different corporations, they have different default risk. What does it mean? What do we mean by the default risk? Default risk, it means what is the chance the company is not able to pay you back the interest and the principal? So if the chance is very high, if the company is able to pay you back the whole interest and the principal, we'll say default risk is very low. If you're talking about the big famous major companies, so which are listed in a stock exchange and they're very reputable, so we can say the default risk most probably is low for these companies. But you might find some companies which actually they're not that reputable, maybe their credit history is not that well, so actually you are risking a lot. There is a chance you won't be able to get back your principal, let alone the risk, let alone the interest. So that's a high risk for you. So we'll say default risk here is high. So to encourage you to buy bonds from such companies, usually they offer very high coupon payment. So if let's say you're living in an economy which inflation is 3%, 4%, and the coupon rate is like 20%, you should think twice, which it means the default risk is high. The company may not be able to pay you back the principal and the interest. So there is a high default risk in this case. Now, there are some agencies out there in the market, which actually what they do, they rate different corporations. So for example, Moody's is one of those companies. What they do, they actually rate based on different criteria. So they go with triple A, triple B, and as you are moving from triple A to down, so double A and A going down, actually the credibility of the company is going down. The default risk is going up, which means there is a higher chance the company is not able to pay you back. So if the company is highly rated, so we are usually talking about better than double B, we'll say these bonds are investment grade bonds. If the company is rated as double B or lower, B, triple C and lower, we'll say these are speculative grade or high yield bonds, or sometimes the informal term for those companies is junk bonds. So next time you consider to invest in bonds, make sure you consider their rating, and based on that decide whether you want to buy the bonds of those companies, yes or no. Thank you very much. This is the last lecture of this module. Next class or next lesson, we'll talk about some major notes, and also I will show you some questions and I will answer those questions. Till that time, have a wonderful day and take care. Talk to you soon. Here is Ali Talabi.